Hello, and welcome to the BetaKit podcast. I'm Katie Lohr, producer for the show. I'm popping in because Douglas, Rob, and I were at SAAS North last week. And while we did a super early live AMA show, the BetaKit podcast booth was also back in business. A range of VCs and CEOs popped by the booth to talk all things SaaS. And for your listening pleasure, we've compiled a whole bunch of the best pieces of those interviews. So, without any further ado, let's dig in.
Who are you and what do you do?
Laura Lenz, and I'm a partner at OMERS Ventures, investing in Series A and B companies in Canada.
So that means you are paying close attention to the state of the Canadian market and probably a couple of other markets. What is the current state of play?
The current state of play, I think, continues to be optimism, but with hesitancy built in. And
optimism from whom?
Optimism, I think, from VCs, right? There are great companies being built in Canada and being continued to be built in Canada despite the current market conditions. Is there uncertainty in interest rates? Is there uncertainty in geopolitical? Is there uncertainty in crypto? Absolutely. But I don't think that excludes businesses with fantastic fundamentals from raising capital.
Fundamentals, you said a magic word because apparently those are important now again. This time last year at SAAS North, that might have not have been the main consideration. And then we've gone through, not quite since from January, but I would say from March onward, just a year-long bludgeoning as markets tightened and there was a return to quality. So I know that we've had conversations previously about how you're talking to your founders to navigate this. Let's just look at founders who did not raise money last year for whatever reason, who might be looking to do so this year.
First of all, this is a market that I love investing in. And I say that not because I'm trying to get in at a great valuation, but because I've always looked at fundamentals and I've always thought that metrics matter. And last year at SAAS North, metrics didn't matter. Composition of revenue didn't matter. Quality of revenue didn't matter. We weren't going down the income statement at below revenue. We weren't looking at gross margin. The industry was funding businesses that had negative gross margins.
Was it just a limited time because of competition or because that metric just didn't matter anymore?
I think for a lot of investors, that metric just didn't matter anymore. People were focused on growth. And growth at all costs, right? I think now investors are rightly so looking at growth with a balance of profitability. And profitability could be at the gross margin level. It could be at the EBITDA margin level. It could be the net income margin, depending on the stage of the business. But metrics matter now. Being capital efficient matters now, which is great.
So it's interesting to hear that from someone who rightly so is like, I really care about these signifiers of like a healthy business and growing. I would assume that founders listening to this was like, well, didn't those things kind of always matter? How would you talk to them about parsing the advice they might be receiving or the direction? Because, we're doing it right now. As a startup publication, when we're looking for guidance on the state of the market, what we should be paying attention to, what founders should be thinking about, it's very often VC driven. And we've had, I think for the first time in about a 10-year period, a pretty dramatic whiplash of what the narrative has been. So are you in a position of looking to rebuild trust with founders who are a little bit like, hey, everyone else was telling me the opposite, or maybe like, hey, what you were telling us last year turns out to be true, so I'm going to trust you more? Like, beyond what investors are looking at, have the terms of the conversation changed a little bit in terms of like the trust relationship? Because growth at all costs is a firmly popped bubble right now.
I mean, I do think there was a reliance on venture money. There was a reliance on your board in pushing for some of that growth at all cost. And so maybe that has broken down some trust. I haven't seen it personally because that's not the type of board I'm part of. But I know that there are other companies out there that are struggling with that. And they were growing in maybe the wrong ways, not being profitable, not focused on their unit economics, not focused on, LTV to CAC, et cetera. And so they are hurting right now. And they've had to go back to the market in a really tough market and raise down rounds. But you know what? they probably did the right thing because it means their company's going to survive another 24 months. And that's what's most important.
Are you seeing down rounds or are you seeing a lot of debt? I'll name this company. I don't remember if you're invested in them, so apologies if you are. We've seen like Touch Bistro raise basically convertible debt, which is like pretty interesting at the scale that they're at. And talking to some VCs, it's like at the later stage companies, that's still an option because maybe there's a disagreement on the valuation of the money they're looking to get or the way to do it. And they're just saying, well, we're going to prove it. We're going to take it this way. And then we're going to hit those numbers. And then you're going to be very happy with the terms of the deal a year from now when we prove it, which is a little bit different when we normally talk about the convertible notes or things like that or safe agreements where it's usually early stage companies really not trying to price or value themselves at the beginning. Are you seeing down rounds or are you seeing more companies like explore debt as a continuation? We're seeing lots of layoffs, maybe cut back staff instead to just extend that runway and just kind of wait it out. Is it one choice or is everyone kind of following different paths?
First of all, I can't comment on the specifics of the Touch Bistro
Yeah, that was just a hypothetical. We'll just assume that OMERS in no way relation to that company.
Second, debt has always been and will continue to be an important element of the capital structure and how you finance your business. There's always been mezzanine. There's always been venture debt in a growing company, maybe not at the early stages because they can't support debt, but at later stages, there's absolutely been a debt component to the capital structure. There's always other ways to extend your runway. And of course, that has an impact on culture and morale and performance.
There's now a huge talent pool that suddenly became available. And I'm assuming the salaries have not stayed at the way that they were over the last 2 years. Are you telling your portfolio now's the time to get that senior director from such and such that could be your CTO or things like that? Is there, and I don't want to say like opportunism and as if it's like malicious or evil, but like, hey, this is actually something that we can kind of strike while the iron is hot.
Yeah, so absolutely striking while the iron's hot on the FANG companies, but also on the companies that have exorbitant valuations that they haven't done repricing of options. It's a great opportunity to take talent away from those companies as well, actually.
Okay, interesting.
Right, or public companies whose share price has fallen so dramatically, whether they've done layoffs or not. It's a great opportunity.
Which is like every public company, it seems.
Pretty much, unfortunately. Yeah, so one of the questions you asked was about down rounds. Down rounds are definitely happening. We are seeing it.
Founders don't like them, though. They don't like raising down rounds.
Of course not. Neither do investors, right? Investors like clean, simple cap tables. But we are seeing down rounds. We're seeing pay to play. And this isn't just in OMERS portfolio. This is
define that in this context.
So pay to play means you participated in the Series B. We're out to raise a Series C. If you do not participate, the Series B shares that you hold will be converted to commons and crushed.
Ooh.
It happened in 2008. It happened in 2001. It is happening again. Pay to play provisions and down rounds have occurred in about 30% of companies that have raised in the last 9 months.
So both sides are hurting a little bit.
Both sides are hurting, of course.
I'm going to be on stage tomorrow with a founder who raised a massive round in May of this year, but not as massive as the round that they could have raised in November. And they feel like they dodged a bullet, but they also feel like they would have been forced to raise a round on a ridiculous multiple of revenue, even if they didn't want to, because there's a collective pressure and, let's say, insanity in the market. Beyond the number stuff, which I know you hammer, what about the psychological component of, well, everyone else is doing it, we can't not do it? Like, because that happened. It happened for 2 years. It happened on both sides for investors and the investees. Are there any rubrics or tips to stay mentally strong against the insanity?
So I think your point is absolutely true. There was a bit of ego raising in 21. There's blame on both sides. Companies maybe wanted to raise a bigger round for that ego. And VCs, of course, have their own fund dynamics that they want to put a certain amount of capital to work, right? So there is blame on both sides.
It's a 10-year plan. The capital's got to get deployed somewhere.
But I think what the outcome of that was not looking at the fundamentals, right? Not looking at capital efficiency, building a go-to-market motion before you had product market fit, right? Not having your sales reps being efficient. And so I hope there's a pulling back on that. I hope there is a looking at numbers in a much more granular way. And hopefully the best sales reps stick around because they're the ones that hit quota every quarter.
Yeah. Okay. So the numbers don't lie if you actually look at them, is what you're saying.
My view And those that know me at a board level or at an operating level know that the numbers don't lie. And I think understanding them is really important.
All right, sir. Who are you and what do you do?
Hi, my name is Leo Lax. I'm Executive Managing Director of LSpark, which is the best premier SaaS accelerator in Canada. And we are highly engaged to build innovation in the corporations around Canada as well.
I'm wondering if you want to talk through maybe at the high level what you were seeing in terms of this year's kind of state of SaaS report and maybe how it compared to last year, because there was some excitement last year. We were coming out of COVID. There was some kind of like boom times.
Yes.
And this has been a bit of a correction year across the board, across verticals, across industries,
I think
right?
you're kind of being very, very kind when you say a bit of a correction. I think it has been a disaster. We have gone from 12 IPOs in 2021 to one IPO in the beginning of this year, 0 IPOs since then. We've gone from almost half of the investment capital in the early stage activities has shrunk. On the other hand, growth opportunities, companies over $50 million, have almost doubled in size in terms of amount of money they were collecting. So the market has shifted completely. And in the Canadian economy, we've seen this shift creating a contraction in terms of where growth is happening.
Yes. The lack of IPOs, I think, I don't know if we need to dig into too much simply because the IPOs that we saw in the prior year was an anomaly outside of itself. We haven't really seen that in Canadian tech, right? So we've almost returned to IPO normal a little bit, despite it being so low. The financing and then the reduction and then the number of deals. I think we have here, there were 56 total deals made in 2022 from the most active top 10 investors across Canada. Do you look at that as not the long tail, but the front end leading component of like the health of the ecosystem? Because that's still a fair amount of deals. And I know the dollars have dropped here across the board, but do you think that the core is strong still?
So it's a difference. And the difference comes in the fact of the type of deals. Yes, the numbers were similar, but they shifted. So there are very few early stage, which is where the seed environment is growing into becoming more successful, has shrunk. The later stage, which means the established companies who normally would have gone public,
yes,
are now staying private and ingesting some of that money internally by raising larger Series C and D environments. So yes, the overall number seems similar, but we have now biased in a very different way. And the bias is less towards building the innovation economy, more towards sustaining what we've got.
So when you're talking to companies, what are you recommending? How are you recommending them making tough circumstances into opportunities?
That's a very good question, and it's tough to get because the most common answer to that question is it depends, which means who knows what. But let me explain what the situation is. I believe what we have is a very, very volatile environment. Nobody can with any level of certainty know what's going to happen tomorrow. Therefore, the only thing I can do as a founder, the only thing I should do as a CEO of an emerging company is keep my mind on the ball today and give myself the opportunity to be agile, to jump either towards an opportunity or to a foxhole when a bomb is coming so that I can protect myself. And I cannot sit there and say, here's my 3-year plan. What I have to say is, I've got my 6 weeks plan. I'm going to stick to it unless it changes, but I have built into my company the resilience, the opportunity to change, because the world is changing faster than I used to be, which used to be one of my benefits. One of the things that technology companies had is their ability to quote unquote be agile. Today, the economy is more agile than the technology companies.
Yes, they're not leading the disruption anymore. They might be chasing it. Okay, sir, who are you and what do you do?
Oh, I'm Louis Têtu, and I'm currently CEO of Coveo. I guess they call me a tech entrepreneur.
Okay. The myth that's been presented to entrepreneurs over the last 15 years has been we'll make it up on scale. I don't want this to be a conversation where you just end up blaming social media and hoodie founders and things like that. But how did things get to that point where people were choosing growth at all costs? And like, was it a cultural change? Were there market shifts? Like, when did you start noticing that you were all of a sudden flying counter to other large sections of the industry?
Well, I don't want to project that we were flying counter. We obviously raised money as well, and we invested as well, and we hadn't invested along the lines of these parameters. But I guess always with a bit of caution, again, looking at keeping an eye on the fundamentals of our business. How is it that you're going to gain operating leverage over time? And basically in our business, which is, we're here at a SaaS conference, SaaS is fundamentally about your growth rate, your growth margin, and your customer acquisition cost, and essentially relative to how much margin or revenue you're going to bring over time, depending on your churn rate and et cetera. These are very, very fundamental economics that, you can basically fire up in Excel. And so you should never lose sight of that. Fundamentally, what is the fundamental value that you bring to customers? How able are you to separate customers from their money in exchange of the software that you provide in this case, or the service that you provide? And are you making money at it? Can you afford essentially going after that market? Those principles, regardless of the economy, always work.
But people have been losing sight, though. There are founders, even SaaS founders, who were nervous to make money too soon because it might impede their ability to raise venture funding. And maybe I'll take this another track, because when I was talking to Laura Lenz earlier today and other VCs, she gave a similar statement. For people who have been around for more than 10 years, who have seen circumstances where the line hasn't always gone up, this isn't as scary as it might be for new emergents. That being said, there are a lot of venture investors who've been around long enough to know better that were still pushing approaches to growth that weren't sustainable based on reality.
Well, it's a ripple effect. There's a couple of things happening or confluence at the same time. Number one, when you're an investor, limited partners, let's say you have a VC fund of sorts, et cetera, LPs give you money to invest. And so you have to deploy capital. And then you get into this circle where essentially you're in competition. So the lower the cost of capital, the higher the multiple, essentially, that investors are going to be willing to pay. And then you sort of get into this circle where deals are scarce and there's a lot of capital overhang, and suddenly investors start stretching themselves, thinking that this is, normal economics, and they forget the fundamental economics versus the market multiples. In a way, you see it today in the public markets. If you do the fundamental economics on a lot of technology companies today relative to their valuation, you'll find a big gap. Fundamentally, just do a standard DCF, discounted cash flow, on many big leading tech companies, and you'll find that they're a screaming buy in some instances. They're trading at a very low rate. But, most investors will look at this, in terms of what are the current multiples, and then basically invest, according to these rules in order to compete.
So the startups are chasing growth at all costs, and then the VCs are chasing deal flow at all costs.
That's right.
And that leads to competition on both fronts that just keeps perpetuating the machine a little bit.
The cheaper the money is, the more people spend, and then the more capital is required, and the more money goes into the system. So it's kind of.
Would you say that this is a bit of a rational cycle, or do you feel that in some way some of the people with the experience know better and are ignoring the things that they know in because of maybe a more of an emotional compunction to not miss out on the deal?
I think there are some people who know better. In general, you have to be in the game, right? And it's a bit of a pendulum, but I mean, if you're an investor, you have to invest, you have to deploy capital, and you have to live with that. I think it's a bell curve, right? You're going to go right of the bell curve or left of the bell curve. I think the issue is that, some people go to the long tail on both sides, right?
Okay. There's a lot of companies in the news. right now that do not have the board governance, the board oversight, the mentorship to have a long-term view.
Right.
In fact, it's beyond short-term. It's immediate, and it's sometimes fraudulent. Like and pick a sector where like we could talk all we wanted to about crypto or whatever, but we're seeing a lack of board oversight, a lack of board responsibility, and really helping steer the long-term vision post IPO. And I'm wondering, is that a is this a cultural miss here? Are we not setting it up properly? Is there too much pressure on the founder?
Is it a cultural miss, or is it a personal choice? I think personally...
Well, if the founder's only been told by VCs that they're an absolute genius and they've never run a company before and they're raising $100 million...
it becomes a personal choice to have the desire to be the dumbest person in the room. And I think there are a lot of advantages, to that. When you're the dumbest person in the room, then you've got a lot of... You can learn. You've got a lot of people who will challenge you. You're gonna evolve. If you find innovation, creativity, and new and better ways of doing things by having, through human collisions and people who come for the debate and so on. If you just put together a board of yes people who have no experience in your space, who've not done it before, and et cetera, and will just come to the board to listen to you and tell you you're a genius, in my opinion, that's a recipe for failure.
Hey founders, do you need help with your business? Well, thankfully, Caravel supports you through it all, from incorporating a new company to raising funds as you scale, all the way to successful exits. Caravel has been a leader in Canadian legal innovation for years, and their lawyers are trained at the best firms in Canada, meaning they have the experience you're looking for, but with a new and innovative business model and flexible rates that deliver excellent value. To learn more, visit caravellaw.com, that's CARAVEL law.com, or reach out to their client happiness specialist, Felicia, at info@caravellaw.com. Who are you, and what do you do?
Hi, I'm Ria Bhavnani. I work at Shopify on our product pricing and monetization team. And what that team is it's a dedicated team within Shopify to help define what our pricing strategy should be for various products and how we monetize them. So that's everything from working on when we're launching a new product, what will that underlying business model be, to, hey, we have this product, we're expanding into a new market, how do we adapt our pricing there? And then once we have products that are more mature in the market, how do we start to optimize that pricing over its life cycle?
So why don't you give us the rundown of what you're trying to teach other companies based upon what Shopify's learned about how it operates?
Yeah, so we just had a great session with Patrick Campbell from Profitwell and El Pato. So we talked a lot about usage-based pricing and kind of that shift from SaaS companies moving from purely subscription model into usage-based. That's something that Shopify has kind of established across our mix of products. So we have a monthly subscription cost, but we also have things like payments, which make more sense to tie to a usage-based pricing model. And just kind of talked about the pros and cons of what that is for a business, shifting to that model. I can go into more there. And then the other thing that we talked about was just going through a price change. Obviously, that can be fraught
yes.
with hurdles along the way, and just kind of how to navigate that. What are the anchor points for making a price change? And then how do you kind of see that through and manage that with customers?
Let's start with the price change stuff first, just because I know that is, I would say, kind of like unavoidable at this time of 2022, just in terms of navigating whether it's inflation or any other components. The companies are having those conversations internally.
Yeah.
How are they communicating that externally? But then also, how are they maybe identifying what that new revised number needs to be?
Yeah, it's a great question, and it's going to look different for every business for sure. I think one thing that we try and do at Shopify is really focus on what is the value we're driving for the customer in the market. So, you just touched on this is a time when a lot of companies are thinking about price changes, and sure, that's true. But Patrick brought up a great slide which says that really companies should be thinking about pricing constantly. So yes, it's maybe more relevant in this market, but it's something you should always be thinking about to grow your business and to evolve it.
Thinking about or testing? Like, do you actually mean like almost A/B testing pricing relative to like web page, landing page conversions? Or just getting a sense of what the comfort level is?
Always thinking about it. I think there's moments when it makes sense to do A/B testing. That's not always the case. You also have to manage what that is from the customer experience. So I think we've all been subject to Spotify or Netflix where you're kind of just like looking at something and you get kind of beta tested for that. So kind of just making sure you're managing that customer side of the experience when you're doing A/B testing. So it's not something we do as an always on methodology. But back to your question and just like what the right number is or how to think about that. So we start with like what is the value we're driving and where do we feel like that sits within the market. And then that becomes our anchor rationale as we move through that price change internally within the company. Because as you go through a price change, there's going to have different stakeholders with different biases and objectives that they're trying to meet. Some people are just trying to grow the merchant base. Some are trying to just manage profitability. So kind of bringing all those stakeholders together and coming back to what that value is for the customer is really important.
Okay. I would say at this point in the game, Shopify has a lot of confidence in terms of like the value that it provides and maybe what it can charge for. I know early in my entrepreneurial journey, making the ask and setting that price that was maybe reflective of the value was a little bit more difficult. Do you have anything, whether it's strategically or just like mental rigor in terms of, putting the ask out there for charging what you're worth? Because I think, we could have a conversation about surge pricing on Uber and Lyft and rail against that. But I actually think there's probably more entrepreneurs, particularly listening to this or at this conference, who are probably undercharging for the value that they're offering and just not willing to maybe ask and get the no.
Yeah, I think a lot of companies are hesitant. And I think it starts with, you can do this, you can manage the risk here. You can start with a smaller group and test that if you want. So whether it's A/B testing or just like a phased rollout to really gauge merchant or customer reaction if you're unsure. But you shouldn't be afraid to ask for what you're worth. And you also have to make sure that you're mindful of what your customer is going through during this time as well. So just like we're seeing increased costs, that's also the case for our customers. One thing that I would say we try to be very thoughtful about and every business should be thinking about is just like the timing of that price change for your customer. So if you are going to do a price increase, make sure it's not at a time where it's detrimental to their business. And also keep in mind, if you're going to make a price change, you shouldn't be making them so frequently and hitting the same customer segment each time.
Okay. When you say not detrimental for the business, do you mean in terms of notice or like specific times of the year where it's like it's the holiday rush, why would you, or we're all on vacation in the summer, kind of like, is that?
Yeah, but both. Like you want to give ample notice in case, depending on the magnitude of the price change, like you want to make sure you're giving them ample notice so they can adjust their business as needed. And then also, and there's peak season. So right now we're heading into Black Friday and the holiday season for Shopify. Big time for our customers. And so we want to make sure that they're focused on growing and scaling their business at that time versus trying to manage the change in the back end.
Gotcha. This is not a time to be experimenting. This is a time to be
supporting,
amplifying. Okay. Do we want to go back to the usage-based pricing and why that's so popular right now? And particularly in like a SaaS environment, the goal was the recurring revenue, even if you can bundle that. Is it more experimentation? Is it going back to approaches that kind of had died off or slowed down at the beginning of like this kind of Web 2 commerce boom? Or like, how are you seeing that? Because I was on stage earlier today talking with a company that's actually in the middle of this downturn, switching from a subscription service to usage-based pricing because their customers just ended up paying more. Is it recession-based mentality or like what's going on?
Yeah, I think you can argue it could go both ways, right? Like the benefit of SaaS is that it creates cost predictability for your customers, which might be really important depending on what you're offering, and it creates revenue stability for your business. But the benefit of usage, well, there's a couple benefits, but it depends on the product. But you, for one, are widening the segment that can access your product. So you're lowering the barrier to entry. And so depending on what stage of growth you're at, that might be very helpful and can help grow your base at this time.
All right, sir, who are you and what do you do?
I am Pete Housley. I am Chief Marketing Officer at Unbounce. Unbounce is a global leader in landing pages. We've been around since about 2009, and we are currently undertaking some major innovation projects to set ourselves up for future success and play in this world of AI and machine learning. And so on. Certainly, from my perspective, as a marketer,
you're the growth guy, right? That's your ticket to punch.
I am the growth guy. And when we think about growth, we think about acquisition marketing, and we think about retention marketing, and we think about the cost per acquisition of a new customer, and we think about the revenue retention and the churn and the ARPU and all of those kind of things. In my opinion, in this market, we need to be laser focused on our data and our analytics to really understand the behavior of the cohorts, the return on investment of literally everything you're doing, and focus and make very, very solid choices given that.
Because you can't have any fat right now.
You can't have any fat right now. And here's something interesting that I've done. In the last 6 months, I've actually lowered my paid media by 30%, and I've decreased my cost per acquisition by a half.
Okay, so those metrics, though, are in service of goals and objectives, or they at least should be at your organization, right? Have the objectives changed? Have the goalposts moved for marketers? Because we've been having conversations with VCs and founders in this booth, and certainly the objectives have changed at the leadership level for the company broadly. How is that laddering down beyond just efficiency? Is it more in terms of customer retention? You aren't exploring like new markets or things like are CMOs at tech companies right now being handed a new portfolio of objectives, or is it do more with less?
Certainly, as we look at our business and we think about some of those North Stars, like the rule of 40, 20% growth, 20% profitability, 30% growth, 10% profitability, and every combination in between. Certainly my approach as I have revenue accountability is to forecast conservatively and beat the forecast. So my bidding on annual operating plans and formalized budgets is going to be the default to a conservative forecasting model, which would be predicated on the last 3 or 4 months' behavior of stats and facts and attribution, so that we don't get ourselves into tricky territory, and so that we don't invest ahead of the curve and then not deliver the ROI that we promised in the first place.
Okay, so you're not promising the world to the leadership team. You're saying this is the baseline. I guarantee we'll stick to it.
This is the baseline. I guarantee we'll stick to it. And then on top of that, we can add growth vectors. Maybe that's a new PLG initiative. Maybe that's going to be a price increase.
But you also said that you're not really doing any paid on Twitter. One of the current channels that has been around for 2 decades now, basically, is going through beyond the content on the channel. Like the channel is the content. There's been a lot of reporting on how advertisers are staying away. There's potentially some brand risk. There's obviously huge misinformation risks. Like, are you evaluating, like, this isn't back in the day of like, do you know the value of one Facebook follower is X amount of dollars? Like, we have evolved beyond that, and the platforms have evolved into something else. Is this just, to your point, right channel, right tactic for these kind of specific things? Or are there just some platforms now where you're just like, stay away? Absolutely stay away.
I think your example about Twitter is really an interesting one. Today in 2022, we love purpose-driven brands and brands that really have a greater good that they play in this world. And I think we could argue on whether or not the free speech policies that are coming and going are making sense or not. But certainly how the world is seeing Twitter treat its employees right now is frustrating. And so it's interesting to see the advertisers are pulling away and saying, we don't really support this. I can tell you at Unbounce, we are a purpose-driven brand guided by our values, and the values are our North Star in everything that we do. And for that reason, I would imagine if I was to advertise on Twitter, I would get some pushback internally.
Well, is that more acceptable now when you see major brands like Nike walking away from spokespeople over, I don't want to get into why they're doing it, but this isn't just when you're talking about that purpose-driven model, that there's been more traction in that regard of making decisions that aren't just purely profit driven.
There is more awareness on social responsibility than I think there ever has been.
Is that just in terms of risk mitigation, or people finally feeling confident to kind of live their company values? Like, or is it, how do you differentiate between that? Is it just like we need to kind of live our values on social because otherwise we'll get the shit kicked out of us? Or is it we have the strength and the self-confidence to hold firm to this and not be anything other than we are?
I think as individuals, we want to espouse our own values, and we want those also reflected in the companies that we work for. And so there needs to be an alignment through the line on that front, or there's a disconnect.
Let's follow this up then, because I said before, you're preaching to the choir here. I started as a digital marketer. I know what it's like to be a marketer at tech companies, at engineering-led companies, at companies that don't necessarily... we're not the first people hired. We might actually be the first people let go, given a downturn, depending upon circumstances. And early in this conversation, you were talking about kind of pitching to the leadership, hey, we can hold the line on this baseline and then look for opportunities for growth. Any advice to marketers right now dealing with environments where maybe because of certain founder decisions, certain priced rounds, or certain growth strategies that are drying up, having that conversation with leadership teams where they're a little bit more stressed out and maybe not as inclined to listen to the marketing, sales, comms professionals on the team? Because that is as much as, Canadian tech is B2B SaaS, like we're here in it at SAAS North, that engineering-led component is a huge part of that. So talk to the marketers out there right now who are maybe having some trouble having their voice heard and understood in this environment.
Great question. As marketers, marketing is definitely a lever. The programs we do, the paid media we run, the organic tactics, and so on. And we need to have the data and the evidence to support how it's working and where it's working. So armed with data, marketers can, get the outcomes they're looking for from the executive teams. I also think the critical role of marketing is to be the voice of the consumer and making sure they have their ears to the frontline consumers, and that they are playing back to the engineering folks and the product-led growth teams.
There's a storytelling component to this, right?
There's a storyteller component to this, absolutely.
Anything else that we're leaving on the table here that you're going to be talking about on stage at SAAS North that you would want marketer? Because, we're going into the end of the year. They're doing their Q1 planning. They're doing their calendar 23 planning. Anything that you're doing right now that you're like, just do this thing. Just get this in as part of your practice and your process.
Well, something I was thinking about this morning was, as we think about what the next 2 years looks like, and if it really is going to be 2025 coming out of the recession, what are companies doing for innovation, product-led growth, and really making sure they have competitive advantage coming out the other side? So what was occurring to me was, are companies doing enough R&D to make sure that when we do come out the other side, they are fiercely competitive?
Who are you and what do you do?
My name is Natalie Archibald, and I lead the people team at Clio as our VP People.
I'm interested actually more right now in, as people kind of explore a return or a new, like what we're keeping with us over the past 3 years, like what's sticking from how things were being handled mostly remotely or at best hybrid, like what's continuing through.
There's obviously so much difference depending on the company that you're with. What I will say is the approach that we've taken at Clio is one where we realize that employee choice and flexibility is our greatest asset. So the more we can design a workplace and a way of doing work that is conducive to people that have very differing needs and preferences, the better. And that helps us in numerous ways. It helps us engage and retain our top employees. It helps us ensure that we have diversity on our teams because people have diverse needs and perspectives and views on the world. And if we design a workplace that allows for all of those things to exist at their best, that ultimately serves us better as an organization. So flexibility and choice, number one, is the thing that we've seen. The second thing is that I think we kind of have put to bed this idea that you can't get work done or be productive if you're not physically in an office. Also, we've seen sometimes the contrary, where people might decide, I need an in-office culture to be my most effective. And that's great too. But again, it comes back down to people being able to make decisions to conduct work in ways that work for them. And that's very individual at the end of the day.
Okay, because I think the second one is like totally proven and stated. Otherwise, none of us would be here by this point. But that first point on bringing the flexibility in the workplace is interesting to me, because I think when we last talked on that BetaKit live stream for our Patreon supporters, you were with a couple other companies who didn't necessarily have the established HQ going into the pandemic. So the digital embrace of that flexibility was a little bit easier, and just kind of like, if it didn't snap on, it kind of became the cultural operating system for the company. I'm wondering, going back now, maybe it's my bias. I'm assuming it's a lot easier to be flexible remote, right? It's like, do you have what you need? You do you? Life, like once that was all sorted and people were dealing with like rotating schedules and maybe asynchronous check-ins and stuff like that, it works because technology scales it that way. When you try to then be like, okay, everyone is going to be flexible and we're taking care of your needs, but you're going to be in this building, in this confined space together. How is that? Is there some conflict there? Is there some tension there? Or what are the intersection points where it's like, oh, this was totally fine over Slack, but now that I'm sitting beside Steve, what he brings for lunch is the worst, and I am going to kill that guy.
Well, here's my take. I think that you have to be intentional as an organization in whatever it is you're designing towards. So you can't just try to make everyone happy in every instance, or you end up having a very diluted experience with nothing really that is creating common ground or a center point of gravity for people to anchor to. So for us at Clio, what we've anchored to is a digital first experience. We call our model distributed by design. What that means is that we will design every interaction to be conducive digitally, because we know that that is almost the greatest opportunity for exclusion. If you have a bunch of people sitting around a boardroom table in person, it's very easy to have a conversation and land yourself at a decision without asking yourself, who needs to be at this table that isn't here? Maybe so-and-so works remotely in, a rural community, but we got so wrapped up in that in-person conversation, we forgot to like dial that person in. So we try to design, digital first as our baseline, and try to bring the level of competency and skill set of our people up to exceed just the bare minimum bar of being successful in that model. So that includes things like how to interact with each other optimally, how to check in, how to provide feedback async when you don't have those like relationship builder social cues to sort of rely on. Those things actually apply just as well in an in-person world. It just takes more intentionality in a hybrid world. So that's what we've really focused on in the pandemic. And as a result, now that we're starting to see people get together in offices, they're relying on some of those skills that they've built up in a hybrid environment to better connect in person. So if Steve's lunch is really bothering you, you can have a really awesome, authentic, respectful conversation about what bothers you, or you can also just pick up and go to a different space in the office, because we've got a ton of communal
because the
areas.
Space is now okay.
Yeah.
I was going to ask, because I understand like the digital as baseline solves a lot of problems and changes the in-person to be value additive in the ways that I think we can all recognize that it is. I was more interested in the specific flexible components of being in person that are then tense or harder, or I would say lead more to actual, when you have molecules
Physical,
in space, there's like
yes.
some conflict there.
So let me share a bit about what we did at Clio during the pandemic. So we used it as an opportunity to completely retrofit our offices. And what we did was we underwent a massive renovation, more in our Burnaby office than in some of our others, just because of the amount of space we had. It's a much larger office. And we designed intentionally for things like shared communal spaces, phone booth style rooms that you could take for a Zoom call if you didn't want to speak loudly in the open concept sort of like bullpen areas.
I wouldn't know what that's like at all as I look at our open air podcast studio at SAAS North.
Exactly. We also learned a lot, like I hope many organizations have, about the different needs that employees have from an equity and inclusion perspective. And we really designed around physical accessibility and designed in a way that would make our offices much more accessible to people with a broad range of interests and needs.
Okay. So it's not the jerk 2 cubicles down anymore. You're going into a space that's multi-purpose designed, and everyone's learning, and I'm assuming you're reinforcing learnings on how to share that space
Exactly.
the same way that they would share, like have good hygiene in the Slack and stuff like that.
Exactly. Yeah. And then designing some really intentional opportunities for people to get together and connect, because we also do know that that is the social gas.
Like Fight Club, like if they want to get their stress out, they just
exactly.
the Team Fight Club. Okay.
They can meet in the yoga room.
Okay.
Take it out.
Yes. That is the much more positive example that I should have been reaching for.
Yeah,
but I went
exactly.
All right, who are you and what do you do?
My name is Sean Silcoff. I write about technology for the Globe and Mail, and I co-wrote a book that you have not read.
Fuck, jeez. Okay. Sources can confirm both of those things, but we'll dig into it. How do you feel about the current moment? Because I think this time last year, we were having you on the podcast talking about IPO explosions. Is the window still open for more IPOs? It was a banner 2021. We are closing. I don't know what the opposite of a banner year is, but it's certainly this year. How are you looking to contextualize this, either based off your reporting, informing other reporting, or just as like a human being trying to navigate a very weird business environment?
So I've been writing about business for a quarter century. So I've written about up cycles and down cycles and up cycles and down cycles. I wrote about tech in 99, 2000, 2001, 2002. That was a euphoric up and a hard crash. I was writing a little bit about the credit crisis, though not really so much about tech at the time. And we've been in kind of a venture super cycle here that came out of 3+ major technological advances, right? The arrival of mobile, the shift to the cloud, and the adoption of technologies like AI and data mining. And it created this massive sustained opportunity. And I think it's thrown things like venture capital out of whack. It's been kind of like up and to the right for a decade plus. And venture's hard. I mean, I interviewed Chad Bain several weeks ago. He's the top tech lawyer in Canada. And
Disclosure, BetaKit's lawyer.
Right. A lawyer for a lot of tech companies. And he's like, excuse me, but this is how venture is supposed to work. The power law, right? You invest in 10 companies, one is supposed to be the dynamite, a couple might make your money back, and most of the rest are expected to not work. And that's how venture is supposed to work. And what's been really interesting is, look, we're in a very negative news cycle now. Valuations crashed, interest rates are going up, inflation.
Hear it on the streets. Sean Silcoff only wants to write about layoffs.
Well, that's the thing. So it's like this up and to the right mentality. People thought that I get the sense sometimes people thought this was permanent and that I'm supposed to only write the good news. I try to write the news and I'm trying to capture what's happening. And what's happening right now is layoffs. But, this morning we had a story that I think is both a good story. It's good news and bad news. Cement and Tealbook both laid off between 13 and 20% of their staff. But Cement also raised $40 million. And they did it at an even valuation the last time. People say that flat is the new up. So if you can maintain your valuation on a financing, that's equivalent to what used to be raise money at a higher valuation.
That also means that the prior valuation was glitter and dust, right?
In some cases, yes. But both companies have done is they've made major investments onto their technology platform that is supposed to increase their utility to their customers and their TAM. And that's what you want to see a business do or a tech business do. Look, the economy is cyclical, and it's been that way for a lot longer than you and I have been here. And we're just going on the downside of the cycle now. And if we're not accurately representing what the downside looks like in our coverage, then we are not doing a service to our readers. And it's not like I'm quote unquote some cheerleader turned skeptic. And anyone who'd think that should probably take a deeper look into how the news media are supposed to function.
Yeah, and there's a lot of that right now. We can dig into this a little bit. I know there's been some comments on Twitter by some Canadian VCs asking, or claiming things would be a lot better if Canadian VCs and Canadian media spent less time kind of ripping apart companies struggling right now and spend more time pumping them up. And I understand the sentiment, but it's completely misaligned to our responsibilities. But I also feel like right now you have the CEO of the largest Canadian tech company openly questioning the value of journalism and the work that we do, as well as the world's richest man, basically looking to raise the level of the average person to be equal to that of any journalist. What do you think it is? For reasons, because there's a belief that we have as journalists, this hidden secret agenda, that we're getting it wrong, that because people don't understand the work that we put in, like the hurdle that we have to clear to publish something that we're like legally liable for. Why do you feel that there's disconnect between people understanding what our responsibility and our role is? It's not just because the line's been going up for a really long time.
Well, the answer is complicated, and books have been written about it.
I haven't read those either.
One thought I would say is the media are not an extension of a company's marketing department, and founders should not think of us as the if they want only positive things, they have people on staff who write marketing who do that for a living and work for them, and that's not what the media does. We try and accurately capture what's happening and present that to readers, listeners, viewers. We don't always get it right. We don't always get it first. The FTX story breaking in real time, a lot of that has happened on Twitter, but also a lot of the best coverage has happened in the mainstream media. Mm-hmm. And I think you're right. I think it's a little problematic. I could use other adjectives, but I'll just say problematic to see tech leaders or anyone dunking on the media, because the media perform a vital role in democracies in the dissemination of information. And we've had critics for a long time. I mean, the Vice President of the United States, I think over 50 years ago, referred to media as the nattering nabobs of negativity. I just shrug at that, and all I can do as a journalist is try and do my best job every day, and as do you. And yeah, we're gonna have naysayers, and I can't fix that. I can just try and do the best job that I can do.
I get the time as a flat circle, but also that comment was made at a time in which journalism was the media. And I'm wondering if we need to get away and we need to separate ourselves from the concept of media at a time in which, honestly, the work that we do is a very small subset of the media landscape, when the vast majority of it is social or creator-driven or media from individuals and organizations that do not have the same goals, rigor, or processes that we have, but are placed right beside us. And I'm glad you summoned the specter of FTX, because a lot of it has been broken from influencers on social media in the crypto space, which are direct sources of information. But as we've seen from the players in that company's story, they're also not reliable. I have a hard time being too critical, though, when I know that from all the great journalism that's happened in the last week, doing the post-mortem of a company that was soup to nuts, seemingly a scam, I also know that anyone can put up the Fortune magazine cover profile of SBF and say, where was journalism then? So how have you been navigating the work that you do, not only as a journalist, but like being on the hook with every other byline that's out there, regardless of like quality intent? Like, how much shit do you get for BetaKit articles, I guess is what I'm asking.
I read BetaKit for the truth.
You're always looking for like what the story is, what's the big idea. And I'm like, Sean, I'm up to my eyeballs in stories, but you seem to want to create this unified principle of tech or Canadian tech. Where do you feel the story is at right now? Is it simply a matter of the fact that for the first time in a decade, economic conditions have caught up to tech businesses in a way that they were just able to ignore because they were able to just print cash and find cheap capital? Or is there something else going on when we have the person responsible for restructuring Enron saying that FTX is like the worst thing he's ever seen.
Well, you know what Warren Buffett said, right? That when the tide goes out, you see who's wearing a bathing suit. I think we're in that moment now where we're going to see who's prepared and who's not, who's been building businesses based on cheap investor capital and not on sound unit economics and path to profitability, et cetera. I look around at a lot of the companies I cover, and I think these companies are going to probably survive just fine through the recession. Might they cut 50% of their staff? Probably. A lot of them will cut deeply. A lot of cuts are still coming. Will there be tough times? Sure. Enterprises are going to hold back on spending. There could be a deep freeze, but the tech sector bounced back from 2001 very nicely. Like, look what came out of that. Google, Amazon, Facebook, everything that we talk about now, a lot of those successes were born out of tough times. Shopify really started to hit its mark coming out of the last downturn following the credit crisis. Tech innovators are going to keep coming. I think a lot of the companies that are here now are going to continue to succeed and do well. Things might get worse before they get better, but it's not like the tech sector is going to go away. It's not like it's going to disappear. I think it's going to be fine here. And I think we're going to be talking in 10 and 20 years and say, remember when we worried back then about the sector? Well, just look at us now. I think that's a realistic expectation. So,
do you think that will continue if companies continue to be almost allergic to constructive, grounded criticism of their practices? The companies in 2001, 2002 didn't have much of a choice. It happened to them. But the companies that you talked about, that we talk about now, that came out of that, have responded to market conditions and were not immune to paying attention to the criticism and iterating and pivoting and navigating. I think now we're seeing a moment where it's like any criticism or any statement of the current reality is seen as something unwanted or unneeded or harmful. Sean Silcoff, relentless optimist, but that's got to be grounded in companies paying attention to what the real is, right?
Well, what is it, the 5 stages? Maybe some people are still in the denial stage or the 12 stages or whatever it is. I think...
what stage is Toby in?
Ask Toby.
Okay. Toby, come on the podcast.
The BetaKit podcast is produced by BetaKit Incorporated. It's edited by Katie Lohr, and its hosts are Rob Kennedy and me, Douglas Saltis. To learn more about how you can support this podcast, head to patreon.com/BetaKit.